Hello everyone, welcome back to another episode of B Grade Economics. This is Nate, your class leader. Let's get started. So today we're going to be going over risk asymmetry and outcomes. We'll go over risk, volatility, known and unknown risks, and the external versus inherent risks. Asymmetry, we'll talk about symmetry and asymmetry and how asymmetry investing is going to benefit us. Risk is ultimately just the possibility of loss or peril. It's just the chance that something can happen to you, that something negative or positive can happen. What is the risk or the downside versus upside? It's not whether or not a coin flip will land heads or tails. It's what will happen if heads or tails is selected or as a result. When it comes to risk, what we're talking about in investing is mostly volatility. Volatility is inherent in markets. It's going to happen. We can have muted volatility or we can have very high volatility. The way I see it in investing and speculation is that volatility benefits you because you can buy the dips and sell the pips. You can buy the low, sell high. If you have low volatility, that can provide you stability for long-term investing, especially if you don't want to see the value or purchasing power of your account change drastically. So the difference in buying a cryptocurrency versus buying gold, the cryptocurrency might have way more volatility, but gold will have way less comparative volatility. That doesn't mean that your value won't go up and down, it's just comparative. So everything's always relative to what we're expecting and what we can get out of it for that volatility. Known and unknown risks. When we're talking about known risks, we're talking about something that you know is a possibility of a risk. Now, that may not mean that you know the full extent of the results of that risk, but you know what the risk is. If this, then this. Now, the full result may be an unknown factor. You may be blinded to it, but you have some perspective of, I know what that risk is. I know it's there. You can choose to ignore it and misaccount for it, or maybe not account for it as much as you should have, but it is a risk and it is a factor. Unknown risks are the dangers that we can't predict. So we have to hedge this by opening up our horizons as much as possible into the decision and incorporating other things into the decision-making process, outside forces everywhere that we can, in order to create a shield around the unknown, because the unknown is always much larger than the known. When it comes to inherent risk, we're talking about built into risk versus external and the compounding risks. Inherent risks. Let's talk about raising a wolf. Wolves and coyotes are an inherent risk to somebody who has a chicken coop, right? They're a danger. An inherent risk to wolves or foxes is that they're dangerous to livestock. An external risk would be the fox itself being the external risk to the chicken coop. There are other risks with having a chicken coop. The cost of feeding the chickens. That is a risk, right? That maybe they don't produce as much as they consume. Let's put that as a potential risk. It's a very small margin risk with the chicken coop, I would think. But overall, there is a risk there. The fox is an external risk. It can be a known risk because there's foxes in the area. You could live somewhere where there are no foxes. So a fox showing up would be an unknown risk because you didn't know they were there. Maybe you just never considered it. Compounding risk would be, I own a chicken coop and I own a fox. I have now applied worse risk here than needed to be, or these events have combined because now I have a chicken coop and foxes. I can take control of those known and unknowns and make certain things known or hedge the risk. I now own a fox, or I own a dog that is trained, and it will not attack the chickens, and it will ward off other foxes. There are multiple ways to look at these perspectives, but it's just things to think about on inherent risks, the external risk that is the fox, and then compounding risks, applying poor decision making or events happening together. So when we talk about asymmetry, this is a huge force in investing. It's the uneven distribution towards something, towards a result. The mean or the median is where the majority of the result lies, in most cases, in a standard normal distribution bell curve. What we're looking for is positive and negative asymmetry to favor you. So when you're trying to pick out asymmetry, you want asymmetry that is skewed in your direction, meaning that the majority of the opportunity is going to be in your favor of the result and less likely the other way. That's your risk asymmetry. So putting it simply, I have this little graph. Most recently, everybody on the internet has seen the chaotic good, chaotic neutral type, where characters fit in a chart for where they fit inside of being a good person or bad person character. This little 9-grid chart is essentially to help you figure out where you want to be on your risk. And so this is the risk spectrum to return range. Your risk spectrum has positive being greater than negative results, a neutral result, or negative being greater than positive results. And then the return range has the negative return being greater than the positive return, versus the positive being greater than the negative and a neutral realm. Now, true neutral, we look at the center of the chart. We see that the return range was neutral, meaning that that the risk was neutral, meaning that it's a 50-50 chance. The return listed would be that the target is reached versus less than half the target. So if we think about how we make returns on a stock, to simplify this, I invest $100. It's a 50-50 chance that it goes up or down. And the downside is a 50% drop. So I go from $100 to $50. The upside is 100% gain. It's $100 to $200. That is the same movement. A 50% loss is the same as 100% gain. So my neutral, it's my neutral chances of it happening versus the neutral results of either it goes up or down at the same rate. 50% down is the same as 100% up, because let's say if I have 100 and it drops 50%, I now have to double my money again to catch back up, if that makes sense. So I have $100, I go down to 50. I now have to go up 100% to get back to $100. So that's true neutrality. This is a very symmetric skew, and it is not hedged towards us in any way. So on the far end of the spectrum, for what we want is that the positive result is much more likely than the negative result. And we want the target, the downside, to be less than half of the upside. That would skew it. That skews the chances of the result to be asymmetric in your favor, and it skews the return to be asymmetric in your favor. So we have compounded this positive result for both the chances of it happening being better and the results for you to be better. Even if the target isn't very high, the loss is less than half of the target, meaning that you're losing less than you would have gained if it went the other way. So you're taking less risk for more reward, and it's a higher chance that you're correct. Now, this obviously is a massive spectrum and can go very large, but this is just generally the viewpoint between these 9 areas of comparison. If we go to the other far end for the negative side, we have up in the far upper left, we have negative being greater than the positive, meaning that you're more likely to see the downside than you are to see the upside. And the target on the downside is greater than 1/2. Or sorry, less than 1/2. Less than 1/2. Sorry. So if it's less than 1/2, divided by less than 1/2, what that means is if it's like minus 60%, then you're down even further than going up 100%. So you want to see it divided by a greater number than 2. You want to see it be less than half, as opposed to being more than half. Overall, what we want to stick to is from that neutral center to the right, to the bottom, and all the way to the far corner. The closer you can get into the green, the better. And that's what we're looking for, is these 4 squares on the bottom right. So as an example, this is a very broad example because there's a lot of other things to take into account. This is just one thing to check your asymmetry. This is the gold to silver ratio since 1980, 82, 83. The gold and silver ratio is how many ounces of silver it costs per 1 ounce of gold. The price has changed in both, and silver tends to move fast. It moves at a higher percentage than gold when they both move. So we can follow the movements for silver and gold and put it in a little chart here. And as you saw in the previous charting one, we can find channels that they move within. You can see that the gold and silver ratio has moved within this channel, generally ascending over the past 45 years. And we see that if you buy up at the top, silver, your chances of it going back down eventually are pretty high. But as you get closer to the bottom, it averages out in the middle where it's symmetric. So if you're looking for asymmetry in silver, you want to be buying it up near the top. Now, you could switch to gold when it goes down to the bottom and increase your gold holdings. And so you can do this as a trade-off over time. Now, this works more on paper than it does in real life, as we see with premiums and different availability of products and different types of products out there for physical silver. But the concept is here in terms of wealth multipliers, that silver outperforms gold during certain periods of time, and the point in time in which you want to make that decision is visible on this chart. So if we look at the silver versus the gold price over time, and we lay out whenever it went asymmetric gold versus asymmetric silver. And so the red is marked when it was at the bottom of the chart, and the green is marked when it went up into the top of the chart and how long it stayed there. So a line would be a monthly dot onto there, onto the top or the bottom, and a big bar is it stayed in that zone for a while. And sure enough, if you look at this chart from around 1983 up to current times, every time that it signaled red, you should have switched silver to gold because gold was going to outperform it for the next foreseeable future. Once it signaled green, you should have been buying silver because it was going to outperform gold next. And it did eventually. Now, this is a 45-year span, so this would have been a good retirement plan. This is not a day trading move. But it is a way to look at the product as when do you buy, when do you sell. And we see, sure enough, that from 2019 to 2020, it's been signaled green again. Now, since it's pretty high up there, your asymmetry would still be there. So silver right now looks like it's kind of still a buy. I would put a position in both if you were going to look at it that way. Until a red bar is signaled to switch back to gold, you might as well hold your position in silver. So we can see that we can actually actively use this as a reasonable way to identify when is the risk greater to me versus when is the reward greater to me. We can see that there's jump ups in silver versus gold and when we should switch back and forth, and these time frames generally are sensible. We can even see that in 2007, that whole bar was telling you to get out of silver and get back into gold. And then there was a market crash and silver dropped even further than gold, and it told you get back into silver because it's going to go up again. And then it told you in 2011 that silver is going to go down worse than gold, so get into gold. So even though gold went down, silver went down worse by percentage. So you can see how this is beneficial to pay attention to these signals. It's not a end all on the best price, but it is a good comparison on when you should take that asymmetry, where that chances are in your favor, both the chance of it happening and the results of it being better for you than its downside. So thank you for watching on the basics of risk and asymmetry. We'll be going over leverage in the following video. Please submit any comments you have for other videos you'd like to see. We have finished our first trade for 1,000 to 2,000. We're at $1,998 on the account. I will post shortly once it closes the last call option. Hopefully we'll close on Monday at the right price and end it around 2,000. And I will talk to you about where my next trade should be. Again, follow me on Covey.io for active management of a portfolio, and see you all next time.